It's kind of easy to see why the innovation is our second strategic pillar and priority as we go forward. It's also pretty hard to follow, Mike. I hope what you do is take away that what each of our segment leaders are finding in their business are where's the growth opportunities both today as well as tomorrow. And I'll talk a little bit about how we're investing to stay ahead of that curve. But also, I hope you take away that there's a medium to longer term possibility as we look at this space in texture and healthful solutions, a $20 billion addressable market. And you think about what Mike Leonard and his team are doing to be able to say, hey, where has texture failed today? And where can we actually make texture as a part of taste more successful for our customers in any part of the globe? And I think that is, fuel and upside as we think about our top line. So I'm going to want you to kind of consider our business model and that it's quite resilient to both uncontrollable and unexpected changes in the global agricultural supply, as well as the fact that we actually do business in many, many countries. And those countries can have at any moment in time a wide range of economic growth or recession or stability. From time to time we're going to face headwinds and challenges, but with time we kind of overcome those challenges and prove that we can actually grow the business. I'll tie together the growth opportunities mentioned previously by my peers, and then I'll tie that to our long-term financial outlook, and then also share a few more comments on efficiency. And then finally, I'll talk about the balance sheet and our capital allocation priorities to drive shareholder return. So in the fall of 2021, we put forth our last long-term financial outlook. And as you can see by the check marks and the pluses, we really exceeded our targets despite the fact that we had a global supply chain crunch in 2021, the invasion of Ukraine and the subsequent run-up in the global inflation of the cost of corn, as well as then customer destocking in 2023 and 2024. And while we faced these challenges, the whole time we were repositioning the product portfolio and building organizational capabilities to address changes in our business environment. 14% average annual operating income growth has been driven in part by the growth in the markets in which we compete, but also by building new capabilities to better manage revenue development and cost containment. Many of those have been commented by Jim and my peers today. One of those is we invested in pricing centers of excellence. We've talked about hedging tools. Eric has led both supply chain as well as procurement teams to really build out these teams so that we can manage the business more consistently. So if we look back to 2022, Ingredion's profit, cash generation, and ROIC figures have all increased. And now you can say, well, wait a minute, Jim, net sales have gone down, which does that foot with a growth model? But so for some of you listening to our story who may be new, our pricing practices to customers generally reflect up and down movements in the value of the underlying raw materials such as corn or tapioca. And I'll call out here just on the bottom left, that over this short time period, corn values decreased about 30%. So clearly sales didn't go down 30%. In addition, in 2024 is reflecting the sale of our Korea business. So that's kind of taking away from sales in 2024. So what we do, given everything's moving in the raw material market, we have this very agile revenue generation model with our customers. We're very straightforward with our customers about changes in our costs. Internally, we really strive to manage gross profit dollars per ton. And we watch gross margins carefully as a metric for overall customer and product portfolio potential. And some of the profit improvement over the last 3 years has really been driven by the team's efforts towards operational excellence. And I think you've heard a lot about that today. But what our operations team has done is taken an owner's mindset to continually find cost savings to offset inflation. At the same time, they're improving service delivery. You heard Jim talk about perfect order, as well as we continue to invest reliability capital, we're upgrading and optimizing capacity, which then pushes out capital investment. So about 3 years ago, we led the centralization and expansion of our global procurement team. And those efforts today are contributing tens of millions of dollars of savings to offset inflation and drive what we call net structural savings. And so net structural savings, Eric's team has implemented this throughout the company globally. Finance separately tracks it. And basically what we're doing is very much trying to say if we have inflation in our non-raw material COGS, how are we doing our best to try and offset that and level that? We also believe that investing in the capability during normal business environments enables actually more resilient performance when the business environment proves to be more challenging. Right? When the business environment becomes more challenging, that's not the time to say, oh my gosh, we need to do cost cutting. You need to actually do the cost cutting now as reflected in our Cost Smart program, which we will exceed our $50 million run rate savings target. And most of that savings in 2025 will come from our supply chain and operations team. But you need to be thinking about all the time about how you can re-engineer your business and make it more resilient and lower cost when both business is good as well as when business becomes more challenging. So you're going to see us continue to invest in digital solutions through AI. We're going to be thinking about enterprise productivity because AI is not just a tool. AI is you have to step back and think about the entire process. Where's the information coming in? Where is it being converted? Who's touching it? Who's making decisions? And can you actually significantly shorten and or accelerate that process, therefore using less organization resources? We believe this combination of focus on growth and pursuing operational excellence leads to strong financial results. Versus our peers, we've delivered a better net sales change. We've expanded margins and we've grown EBITDA more. And on a comparable valuation measure, our stock trades just above maybe 8 times enterprise value to EBITDA based on trailing 12 months in 2024. I'd highlight maybe that this is slightly lower than that peer comparison, which I believe invites a further look into what we offer as a company. Looking forward for the next 3 years, we anticipate low single-digit net sales growth and adjusted operating income growth in the 5 to 7% range. Although our forward growth outlook is not 14%, which we have stated was partially driven by capability building, we have confidence in the growth investments that we have already started, which will commission in 26 and 27. So let me take a minute to expand on assumptions in our outlook. We hold corn cost constant. We also hold pricing constant. And we hold FX constant. So right now, even though I may be able to look at a 26 futures curve for corn, when we plan 26 and 27 in our outlook, we're holding that constant to today to 25's levels to 25's levels. And that's important because therefore then the change and the improvement that you see in the overall algorithm, the outlook, is actually driven by continued upgrading of the products that are in our portfolio and continuing to work with those customers that value innovation, that are going to value the solutions that we bring in the future. On an adjusted EPS basis, we have assumed repurchase on a kind of historical average over the last 4 years. The business generates enough cash that we should be looking forward and assuming that, and you should be assuming that we'll be disciplined in at least repurchasing shares. So maybe then to address, well, what potential risks are out there? So our outlook incorporates tariff changes that we've seen thus far in Q2 through Q2 2025. And we've noted that in the vast majority of our business is actually made locally and sold locally. So our geographic diversification has turned out to be a benefit in that we really aren't exposed as much to tariffs. But we can't anticipate kind of further tariff changes or revisions to trade agreements over the next 3 years, so we're kind of watchful of those developments through specific U.S. country pairs. And those actually may create, oftentimes everybody talks about risks, but we also see opportunities as well, because some of our global competitors' manufacturing footprint isn't the same as ours. And so we're watchful both of, is it a risk, is it an opportunity, to whether our trade volumes, our pricing, and our margins. So Ingredion's free cash flow generation runs about 50 to 60% in that range on average over a period of 2 to 3 years. And I like to call that out because it's really kind of a global corn cycle. So corn price fluctuations really depend on really the size of the U.S. and the Brazilian crops. And those may take 1 to 2 years to rebalance. So we may see corn rise up, corn may come back down. And over that time, we have to invest our working capital, or we're going to get cash generation from our working capital. So it's really mostly, if you look at our balance sheets, either in receivables, as we're passing through a higher price or lower price product to our customers, or the value of our inventory, which is generally finished goods inventory value. So that moves up or down with corn values. And so in 2024, as corn values decrease, our net working capital change generated excess cash flow and enabling a significant buildup of cash. And currently our balance sheet, we have really no commercial paper outstanding and really only long-term debt. We are comfortable with a long-term debt to EBITDA ratio of greater than 2 times. And I would say that we have creditworthiness capacity up to kind of 3.5 times if an M&A did present itself and we thought, boy, this is strategically right, and this is also at the kind of the right type of financial return for our shareholders. Our capital allocation priorities are balanced between high return growth opportunities and returning value to shareholders. So our first priority for many of the past years has been organic growth investment to ensure that we have the capacity to serve future customer demand. Why we like organic growth: one, we usually know the plant and the people and the place where we're adding capacity, so it tends to be lower risk. It also tends to be supporting capacity on a business that we already have a customer base, and so we tend to see really high returns on organic growth investment. And then just as an aside, in the food ingredient space and the pharma ingredient space, when customers select a supplier, they have an expectation of quality, availability, delivery service, and value to meet their 24/7 demand requirements. So those requirements often lead to a very low turnover of customer buying in our industry. Once they've sourced your plant, that is generally the habituation you see in the buying. And so therefore, organic growth investments for us lead to kind of deeper supply relationships with customers, maybe adding new customers, but when we add those customers, they tend to be pretty sticky. Also, we always look at M&A. I'll speak to it in a minute, but we're actually looking at it so that it's accretive to our strategic growth. And then finally, in terms of returning capital to shareholders, it's an equally important priority. We do have a very consistent dividend, and we've been able to grow that dividend over the last 10 plus years. And then we look at share repurchases as opportunistic relative to both market volatility and our mid to long-term view of the value of our business. We're always running a DCF. We have an intrinsic value, and we're going to look at the stock price relative to what we believe is the future growth, where we know we're investing capital, where we have high confidence that our profit is going to grow in certain countries and certain products. And so we actually look at share repurchase not on a kind of mechanistic basis. We're going to look at it opportunistically. We take a strategic and disciplined approach to M&A. I think maybe first to recognize is that the global ingredients and solutions industry is not fragmented. There's not a lot of little roll-up opportunities. For those opportunities in our pipeline, we're going to first have, I'm going to say, the commercial and the general management leadership take a view that it's strategic. How does this capability add to what we want to do and what our market position is in texture and healthful? How can it have kind of a multiplicative effect on our competitive position? And then we look at a disciplined financial approach. I believe we've demonstrated success in the past in finding synergies and executing on the integration plans. I really think that's Ingredion's powerhouse, is that we plan the business, we know what we're going to do for the first, second, and third year. Different functions have to come into place once we've actually acquired a company and brought it into our culture, into our business. We target a return by year 3 of at least a 10% ROIC. So that includes at least some time for synergies to develop, but it's not so far out that you can't hold us accountable for how did that M&A perform. We also look at a variety of other financial KPIs, but I think that an ROIC relative to our WACC does indicate that we're going to seek economically value-creating opportunities, even though our ROIC today is more in the kind of 14% range. If we can deploy capital and we know that it's going to be deep in our strategic competitive moat, and it's also going to return value to shareholders, we think that those are really good opportunities. And finally, I think we have a consistent track record of returning capital to shareholders. So as I mentioned, first, growing operating income is the best way to create future shareholder value. Just driving up consistent op income, being disciplined about adjusted EPS growth, turns out that I think that's what has driven the performance in the last 5 years. Jim and I can lament together on our multiple, but we're going to stay very focused on the top line, growing adjusted op income, and being disciplined in our fiscal policy. We're going to return part of our cash each year through a dividend. And then finally, as I mentioned, we'll pursue share repurchase, but we've been quite consistent in the last 4 years in share repurchases. And so with that, I will thank you for your time. I'll hand back off to Jim to wrap us up.
Thank you, Jim. Okay, we're at that moment where we're at the end of the presentation and we're going to get ready for the Q&A. I just wanted to thank you again for your attention and hopefully what you've heard, not just with the messages that we've delivered about the transformation and about how balanced and how strong of a company that we are, but how well positioned we are also for the future. And we think that all makes for a very compelling investment thesis. And specifically, it's because of who we are in the market. We're a market leading, again, very diversified geographically, diversified with customers, as well as with our product lines, and are increasingly positioning ourselves to engage with customers providing solutions. And those solutions will, we believe, drive higher rates of growth as well as higher margins over time. And we're a very, very trusted and well-established supplier to a growing global customer base. As Jim just described, we're in a very strong position right now financially from a standpoint of the strength of our balance sheet, as well as the performance that we've delivered in the last 3 years. And we have generated, which is the sign of any great company, a consistent and increasing amount of cash flow. And we believe that is insulated by the business model stability that we've described across all three segments and the competitive moat which we believe we have deepened over these last 3 years. And I think we've also proven that when interest rates were extremely low, a lot of companies chased M&A at multiples that have since come down, and now they have faced a higher interest rate environment where we've stayed very disciplined, found opportunities to invest organically with target disciplined hurdle rates, and that's all driven improved shareholder returns. And then in addition, we have a very experienced and deep leadership team, and not just at the leadership level, but below that. Our culture, I think, is something that really has sustained us. We have great values, a great purpose, and we always lead with integrity. And that's another reason why I think Ingredion is a great investment of choice.